Grid trading bots are everywhere. Place orders above and below the price, collect the difference as the market oscillates. It looks like free money, and there are hundreds of videos explaining how to build one. I built one properly, adaptive spacing, indicator filters, risk management. Then, before running it, I asked a question almost nobody asks. Does this market actually oscillate? It doesn't, and I can show you the exact number that proves it in about 6 minutes. If you're running a grid bot right now, this is the test you should run tonight. The mechanic. You pick a center price. Below it, you place buy orders. Above it, sell orders, spaced evenly. Every time price crosses a level, you fill and you set a take profit one step away. Price wanders up and down, you harvest small profits over and over. Now say the quiet part out loud. A grid is a bet that price comes back. It is short volatility and short trend. If price picks a direction and keeps going, you accumulate losing inventory the whole way down, and there is no mechanism that saves you. So the entire question before any code is whether your market mean reverts, not whether your parameters are good, whether the bet is even the right bet. I built it on USD, RUB perpetual futures. Spacing is adaptive, half an ATR, so the grid breathes with volatility. 5 levels each side, take profit, half an ATR. Indicator filters. EMA sets the center, RSI blocks adding to an overheated side, Bollinger stops the grid when price breaks the channel, and ADX poses new levels when trend strength goes above 30, because trend is what kills grids. Risk. Hard position cap, daily loss limit, drawdown kill switch, exchange side stops. This is not a toy. Code is linked below. Here's the test. It's called the variance ratio, and it's 10 lines of code. Take returns over 1 bar. Take returns over Q bars. If price is a pure random walk, variance scales linearly with time, so the variance of Q bar returns is exactly Q times the variance of 1 bar returns. The ratio is 1. If price mean reverts, moves partially cancel, Q bar variance is less than Q times ratio below 1. That's grid territory. If price trends, moves compound, ratio above 1. That's grid death. 3 years of hourly data, 12,000 bars. Here's every horizon. Bars. 1.0064, 1.043, 12, 1.112, 24, 1.254, 48, 1.127. Every single one at or above 1. And that 1.254 is not noise. With the 12,000 bars, the standard error is about 0.05, so this hits 5 standard deviations above the random walk line. This market trends confidently. The half-life of mean reversion comes out at 2,893 bars. For a strategy holding positions for hours, that number means there is no mean reversion at all. Now, the part I want you to remember, because it nearly got me. My first data pool was 30 days, because that's the maximum the broker's API returns for hourly bars. On that sample, variance ratio at lag 2 came out at 0.818, below 1. Mean reversion, grid looked viable. It was noise. 376 bars is not a sample. And there's a specific reason lag 2 looked good, bid-ask bounce. Price alternates between hitting bid and hitting ask, which produces negative first-order autocorrelation in any market, always. It's not an edge, it is the spread you'd pay trying to capture it. Pulling 3 years from the exchange's public API instead of the brokers, that 0.818 became 1.006, the signal evaporated. If you take one thing from this video, check whether your edge survives a bigger sample before you check whether it survives your parameters. For completeness, I ran the grid on trending data. Minus 294,000, win rate 66%. Look at those two numbers together, because that combination is the signature of every blown up grid account. A high win rate and a negative result. Hundreds of small wins, a handful of catastrophic losses when price picked a direction. The win rate is what keeps people convinced right up until the end. A variance ratio says the market trends. The honest response isn't to fix the grid, it's to take the other side of the bet. Same infrastructure, same broker client, same indicators, same risk manager. Only the signs flip. In the grid, high ADX was a stop. In the trend version, high ADX is a requirement. Entry on a channel breakout, exit on a ATR trailing stop, position size computed from a fixed ruble risk. 3 years out of sample tested. profit factor 2.4, drawdown 12,000, every year positive, longs and shorts both profitable. And here's my favorite control. I ran the same trend bot on a synthetic random walk. It lost money. That's what you want to see. A strategy that makes money on every kind of data isn't robust. It's a bug in your backtest. One more number, and it's the one that matters most. Walk forward analysis. Re-optimizing on a rolling window and testing only on data the optimizer never saw gave an efficiency of 0.51. Forward expectation is about half the backtest. That's roughly 9% a year. A bank deposit in the same currency pays 12.4% right now. Government insured. No drawdown. No 5-month flat periods. No code. So the honest verdict on the whole project is the grid can't work here, the trend version does work, and it still loses to a savings account. That's not a satisfying ending, it's the real one. And if a strategy video you watch never arrives at a number like this, ask yourself what's being left out. Code's in the description. The variance ratio test is the first thing I'd run on whatever you're trading. Next video, why a single train test split proves almost nothing, and the test that replaces it.